I spent several years of my internal audit career as a capital markets auditor, which means I had a lot of discussions around debt investments, equity investments, and even derivative investments. Luckily for you, you don't have to worry about derivatives anymore on this exam. In this lesson, we'll talk about and review a little bit of bond concepts, including the various features that bonds have on the prices that your organization may pay for those bonds. We'll also talk about some of the accounting practices, specifically amortization practices of bond premiums and discounts. We'll then turn our attention over to your equity investments, which are simply you agreeing to invest in an organization through the purchase of common stock or preferred stock. We'll talk about one of the essential calculations and one that you might see on the exam related to earnings per share. We'll also take an opportunity to describe what an organization does when they declare dividends and the different types of dividends that an entity may pay. And for equity investments, we'll also look at some of the accounting treatment that we need in order to record both the purchase and the value of equities as we continue to own the interest in another organization. As we talk about bonds, we need to make sure that you understand something called the future value versus present value. Future value is the amount the bond will pay in the future. Present value is the amount the bond is worth today. When we are valuing bonds, we value them at the present value, not at what the bond value or the bond will pay at some point in the future. You've probably heard $1 today is worth more than $1 tomorrow, and that's what we're trying to figure. How much is it really worth today when we're calculating the present value of the bond? As a bond holder, we might choose to invest in a bond in order to hedge against risk or preferably make a little bit of money. In order to determine how much money you will make, organizations will calculate what's known as their yield to maturity, frequently abbreviated simply just YTM. An organization, when choosing to invest in a bond, will determine their yield to maturity based on a number of factors, including the principal amount of the bond or par value, the bond interest rate or coupon or bond rate, as well as the market rate and the bond maturity. There's an important distinction that we need to make sure you understand as it relates to coupon rate versus market rate. If the coupon rate, which is the interest rate the bond will pay, is greater than the market rate, then that bond is deemed to be sold at a premium. If the coupon rate, again, the interest rate the bond will pay, is less than the market rate, that bond is said to be sold at a discount. There are a couple of other factors that are going to have an impact on the price that a bondholder might pay for a bond. One of those factors is a restrictive covenant. Restrictive covenants may either add to or subtract from the value or price of the bond. A restrictive covenant that is for the interest and benefit of the bondholder would actually increase